All right, hi everyone. Welcome to today's webinar brought to you by IronFX, where we're going to be taking a look at the S&P 500 sector performance. All right, before we begin today's webinar, please take note of the disclaimer, right? The information is not considered as investment advice or investment recommendation, but instead is marketing communication only. And so take note of the risk warning that comes with trading products on IronFX. They are traded on margin and carry a high level of risk, and it is possible to lose all your capital. All right, we're all good to go. Right. So my name is Ketan Ramachandra, and this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we've been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, so today we're going to take a look at the S&P 500 index, right? This is the stock exchange in the US. We're going to take a look at what this index comprises of, what are the sectors that make it up, as well as the individual companies within this index as well. We will also take a look at which are the current leaders in place with regards from the perspective of sector leaders, and will they remain in place till the end of the year. Right, so let's start off by taking a look at what is the S&P 500 index and what is the tradable instrument that tracks this index. Right, so the S&P 500 index is a large cap index in the US, and as the name suggests, it comprises of 500 of the largest US companies. Right now, it is a very diversified index where we have companies from the tech sector, financials, energy, utilities, healthcare, and so on and so forth. So it's a widely diversified index comprising of 500 of large cap companies in the US. Now, these are the sector ETFs, right? So you have the S&P 500 ETF, and the ticker symbol for this ETF is the SPY, and you have the other sectors as well, ranging from materials, communication services, energy, financial, industrial, as well as technology, consumer staples, real estate, utilities, healthcare, and consumer discretionary. And you can see that their respective tickers are also have been listed alongside the name of the ETF. Right, so not only can you trade the S&P 500 ETF itself, which tracks the S&P 500 index, you are also able to trade the individual sectors as a whole as well. And these are the respective ticker symbols that you should be aware of in order to trade those sector ETFs. Now, the S&P 500, right, ETF with the ticker symbol SPY, right, it tracks the S&P 500 index itself. So the S&P 500 index is a diversified large cap US index that holds companies across all 11 sectors here. Now, this ETF was launched in January of 1993, right? So you can see here, this is a 30-year-old, or almost 32, 33-year-old ETF that has been trading for on the US exchanges. Now, when we look at the makeup of the S&P 500 ETF itself, the SPY ETF, and we break it down and look at the top 10 holdings, we can see that the top 10 holdings consist of many of the major large cap big tech companies. We have Apple, Microsoft, Nvidia, Amazon, Meta Class A, Berkshire Hathaway Class B, Alphabet Class A, Broadcom, Alphabet Class C, and Tesla as well. You can see here that the S&P 500 ETF, the SPY ETF, when you break it down, has companies, information technology makes up about 29% of this ETF, financials make up 14.7%, healthcare with 11, consumer discretionary with 10%, and so on and so forth. So you can see here, right, so well diversified ETF with regards to sectors, right, ranging from information technology, financials, healthcare, all the way down to energy, utilities, real estate, and materials as well. Now, when we look at the top 10 holdings of the SPY ETF, we can see that the top 10 holdings make up about, let's see, this is 27, 30, 35, almost nearly 40% of the index itself. So this is quite a heavy weighting or weightage for the top 10 holdings. So what this also means that if these 10 companies are performing very well, if the share price of these 10 companies are performing really well, they are very likely to pull up the entire index. Conversely, when the share prices of these top 10 holdings are performing very poorly, they are likely to drag down the entire ETF itself, entire ETF as well. So this is what is something to take note of for the SPY, right? Because you have quite a high weightage assigned to the top 10 holdings, right? So generally, if the top 10 holdings, if the share prices of the top 10 companies are performing very well, it's very likely to drag or pull up the entire ETF itself, and it probably doesn't really matter what the other 490 companies are generally doing. Conversely, when these top 10 holdings are in a very prolonged bear market, they are very likely to drag down the entire ETF, and that means even though you have the other 490 companies that are doing relatively well, right, it may not be enough to ride out the bear market. That is called to ride out the downturn that is caused by these top 10 holdings being in a bear market. So this is something to take note of, right? Although it's a well diversified ETF, it also is the top 10 holdings have a relatively high weightage comprising nearly 40%, right? And they can have a huge impact on the direction of the overall ETF. Now, moving on, we'll now move on over to each of the other individual sector ETFs and take a quick look at their top 10 holdings. Right, next up is materials. Right, you have companies from the chemicals industries, metals and minings, containers and packaging, and construction materials. Right, and we have some of the big players such as Lind, Sherwin-Williams, Air Products, Ecolab, and so on and so forth here. Now, communication service might be more familiar with these names here, right? Of course, with Meta, Alphabet, Netflix, Warner Brothers, Live Nation, and Walt Disney, right? So these are companies from sectors such as interactive media and services, entertainment, media, diversified telecommunication services, as well as wireless telecommunication services. Now, if you look at the top 10 holdings of the communication services ETF, right, we can see that these top 10 companies, and this is about 23, uh, 35, 35, 45. This is almost 55, 60%. You can see here the top 10 holdings carry a weightage of nearly 60% of this entire ETF. So what this also means is, right, if these top 10 companies, the share prices of these top 10 companies are performing very well, they're very likely to lift up the entire ETF, right? In this case, the ETF is a communication services ETF with a ticker symbol XLC, right? Of course, there are other companies that make up this ETF, this sector ETF, but when you have very strong share price performance by these 10 companies, they are going to lift up the entire sector ETF. Conversely, should these top 10 holdings enter a prolonged bear market, right, it's going to drag down the entire sector ETF as well. So do take note that the top 10 holdings and the amount of weight that they carry, right, has a huge impact on the direction of the overall ETF as well. Now, energy, right, of course, we have all the big oil and gas companies, ranging from Exxon, Chevron, ConocoPhillips, to others such as Schlumberger, Kinder Morgan, and Marathon Petroleum as well. So generally, most of the energy companies come from industries such as oil, gas, and consumable fuels, as well as energy equipment and services companies. Once again, the big boys here, the top 10 here, we can see here Exxon and Chevron already make up nearly 40%. Right, you can see here just two companies alone in the energy ETF, right, energy sector ETF, make up nearly 40% of the entire index. So you can see here, when you add in all the top 10 companies, this is well over 60, 70%. And that means these 10 companies are more than the share price performance of these top 10 companies are very likely to influence the entire direction of this energy ETF as well. Financials, right? We have all the big banks here, right? And other insurance and financial companies. Right? Remember, Berkshire Hathaway is not a bank; it's a big financial and insurance conglomerate. So we've got that. We've got J.P. Morgan. We've got Visa and Mastercard, which are credit card companies. We've got Bank of America, Wells Fargo, Goldman Sachs, and so on and so forth. Right? You can see here, companies coming from the financial services industries make up 34%. Banks make up 23%. Capital markets make up 22%. Insurance companies 16%, and consumer finance making up 4%. Now, once again, right, the top 10 companies here of the financial sector ETF make up a relatively large proportion. You can see here, this is already 24%, 28, 38. This is easily 60, 50 to 55 to 60% weightage as well. So you can see here, a lot of the ETFs, a lot of the sector ETFs, the way they're constructed and the way that the amount of weight has been apportioned to each of the companies is skewed heavily to the top 10 holdings. Right, industrials, right? We have General Electric, Caterpillar, Uber, Honeywell, Boeing, right? And these are companies coming from industries such as aerospace and defense, machinery, ground transportation, electrical equipment, and a whole bunch of other industrial sectors as well. Next is technology, right? Maybe more familiar names here, right? We've got Apple, Microsoft, Nvidia, Broadcom, Salesforce, and these are companies from industries such as software, semiconductor and semiconductor equipment, technology, hardware, storage, peripherals, IT services, communications equipment, and electronic equipment, instruments, and components as well. Once again, here you can see just the top three holdings, right? If you just look at Apple, Microsoft, and Nvidia, this is already 40%, right? You can see a 15, 13, 20, and 12, right? This is already 40% of the entire ETF. So just three companies alone carry a weight of 40%. If you add all the others in, this is easily about 55 to 60%. Consumer staples, right? We have companies such as Costco, Walmart, Coca-Cola, Philip Morris, PepsiCo, right? These are companies coming from industries such as consumer staples, distribution and retail, household products, beverages, food and beverage, food products, tobacco, and personal care products. Real estate, right? We've got uh, companies. These are basically going to be the rates companies, specialized rates, healthcare, residential, retail, and real estate, hotels, and offices as well. Utilities has been a very important sector with the emergence of AI, right? You may be wondering why is the utility sector very strong, has been a very strong beneficiary of AI because of a lot of data center and computing power that is required. And of course, utilities power as well. So we can see that uh, companies in this ETF, utilities coming from industries such as electric utilities, multi-utilities, independent power, renewable electricity producers, and so on and so forth. So a lot of data center companies and energy providers, utility providers fall into this ETF, and they have benefited. The share price performance of these companies have benefited very strongly from from the emergence and adoption of artificial intelligence. Healthcare, we can see here, right? We got Johnson and Johnson, United Health Group, Eli Lilly, and you can see actually healthcare sector has come under uh, uh, pressure recently, right? Especially with the new administration, right? With President Donald Trump coming into his second term, right? Alongside with the new healthcare secretary, right? They've really come uh, uh, the big pharma companies in the US have come under scrutiny under the new healthcare secretary. So because of that, this healthcare ETF and the sector itself has been underperforming the S&P 500 index as well. So we can see pharmaceuticals making up 30% of this ETF, right? A lot of big pharma companies have come under intense scrutiny by the new healthcare secretary in the US. Now, consumer discretionary is going to be more related to companies such as Amazon, right, where we do a lot of e-commerce spending, Tesla, Home Depot, McDonald's, Booking.com, Starbucks, Nike, and so on and so forth. You can see here restaurants, hotels, leisure making up 26% of this ETF, retail, broadline retail, automobiles, and so on and so forth. Once again, you can see here just Amazon and Tesla make up 35% of this entire ETF. You put in Home Depot and McDonald's, you've already got 40, 45, 47% here. You can see here the way some of these ETFs are being constructed. And in terms of weightage, they've skewed very much to the top 10 holdings. And that means these top 10 holdings have a huge influence in the direction of the entire ETF itself. All right, now we will take a look at how each of these sectors have performed year to date, right? Where we're going to be looking at year to date performance. And this is what we have here. Now we can see uh, after Liberation Day, right? For those of you who may not be familiar, 2nd of April was labeled as Liberation Day by the White House, where President Donald Trump unleashed a barrage of tariffs against the major trading partners of the US. And since then, some of these tariffs have been implemented, while many have been put under 90-day pause. as trade negotiations take place between the US and its major trading partners such as China, the European Union, Japan, India, and a whole host of other countries. Now, what had happened during the months of April and May, we saw intense volatility as these tariffs injected a high sense of or increased global uncertainty, increased global recessionary risk due to tariffs being implemented that had caused stock markets, global stock markets, including the US stock markets, to fall drastically, with many indices falling into bear market territory, although it was for a very brief period. But we saw many single name stocks fall more than 30-40%, dropping deep into bear market territory. Since then, markets have recovered quite strongly, right, as trade negotiations are currently in place. And we see more positive news emerge from the White House in the sense that we are not seeing new levies being imposed on other countries, and we also see more positive news emerging from the ongoing negotiations. Now, with that, we can see the S&P 500 has now returned to positive territory from the perspective of year-to-date performance. The S&P 500 ETF is currently up 2% year-to-date, and we can see here, right, almost all the other sector ETFs are in positive territory except for healthcare and consumer discretionary. You can see healthcare is still down 2.9% year-to-date. Remember, Big Pharma has come under intense scrutiny by the healthcare secretary, and this has led to very poor performance of the share prices of these companies involved. Consumer discretionary, such as Nike, McDonald's, Adidas, right, all these companies have taken a hit as well due to the potential impact of due to the potential negative impact that tariffs may cause on their businesses. So consumer discretionary is down 6.3% year to date. Remember, prior to this, if you were to look at the sector year-to-date performance in April and early May, many of these sector ETFs, including the S&P 500 ETFs, were actually negative for the year, right? That actually dropped deep into negative territory, right? But since the end of April, many not only has the US stock exchanges or the major indices recovered strongly, global equity markets have also rebounded together as well. Right, so as a benchmark, right, we're going to be looking at the year-to-date return of the S&P 500. This is, of course, as of yesterday, Tuesday, 17th of June, right? As of Tuesday, 17th of June, the S&P, the SPY ETF was up 1.9%, and we can see that the leading sectors have been as now currently industrial up 8.2%, communication services up 6.5%, and utility sector 6.2%. Remember, I mentioned utilities as well, right? The primary beneficiaries of AI adoption and AI or emergence of AI, followed by, of course, adoption of AI related technologies. Right? Remember, data centers, power utilities, companies are going to be benefiting from increased performance and energy requirements from AI companies and chip makers as well. Right, so you can see here, although the S&P 500 ETF has only returned 1.9% year to date, we can see sectors such as industrial, communication services, and utilities coming in with a much higher return. Even financials is pretty decent, up 3.9%. Technology as well is up 3.8%. Now, with that, let's move on over to the chart and trading view and see where the key technical levels for the S&P 500 ETF itself. And we'll take a look at the three leading sectors as well. So we have industrial, communication services, and utilities. But of course, we'll start off with the SPY ETF and see where this index is, or where this ETF is currently trading. Right, so this is the ticker symbol for SPY. If you type SPY, you'll get SPDR S&P 500 ETF Trust. And I'm currently on the daily time frame, right? So if we mention here, right, Liberation Day was on 2nd of April, right? This vertical marker here was Liberation Day, 2nd of April. But even before that, equity markets were already pulling back quite sharply in February and March because some levies had already been imposed. right? Basically, there were levies on steel and aluminum imports into the US, along other uh, levies placed against Canada and Mexico that had already started to raise uncertainty and start to rattle global financial markets as early as February and March. So we can already see, right, after making its intraday all-time high, take note this level here at $613.23. This is the intraday all-time high that was formed on Wednesday, 19th of Feb. And since then, we've seen the SPY ETF drop drastically, right? We can see from 19th of Feb, and by 13th of March, in just 4 weeks, the SPY ETF had already fallen 10%, or more than 10%. It made a nice counter trend rally by the end of March. However, it then proceeded to drop as low as $481 back on 7th of April, with this ETF briefly entering bear market territory. You can see here from its intraday all-time high on Wednesday, 19th of Feb, to the lowest point on Monday, 7th of April. This ETF had lost more than 21%, falling briefly into bear market territory. However, it bounced up quite strongly to close at $504 on that day, but it was still down a whopping 17.8%. So you can see equity markets in the space of 3 to 4 months had fallen drastically, right? And this is just at the ETF level or the index level. Many single name stocks would have fallen much more deeper than what we've seen at the ETF level. Now, since then, of course, since 10th of April, as um, the tariffs were announced, and then finally some tariffs were rolled back. Some tariffs are currently under 90-day suspension. This suspension is expected to end in about 3 to 4 weeks, right? So as many levies were suspended, or the implementation of levies was suspended, and as trade negotiations commenced, that helped to bring about some relief to equity markets, and we saw share prices of the SPY ETF as well as the sector ETFs and single name stocks start to recover, and we've seen a very strong rebound, right? We actually can see a very nice V-shaped recovery. If you look at the market structure, right, it's basically showing us a very nice, strong V-shaped recovery. Of course, we're not back to the as close as to the all-time highs at around $630, but nevertheless, equity markets have rebounded very strongly, and we can see a nice V-shaped recovery for the SPY ETF as of this week. Now, let's start off by identifying the key technical support and resistance levels, right? So where the intraday all-time high was formed, that was pretty much where we can expect one resistance level to sit at. And of course, we can see here since mid-June, right? Since mid-June, the SPY ETF has failed to break above about $605. So very clearly, this is where the current first resistance sits. And of course, the second resistance is going to be the swing high that was formed on Wednesday, 19th of Feb, and that's at $612. Now, in terms of support, right, I actually can see there's a nice, very significant overlap level at around 575. And when I start it from here, we can see that this level previously functioned as a very significant swing low support back in mid-Jan. See a little bit of consolidation here on 4th of March. Then as price broke lower, this counter trend rally stalled at pretty much the same level at $575. At this point, this creates an overlap resistance, right? By the time the SPY ETF hits this level at 576, makes a bearish reversal. By this point here, this level can be labeled as an overlap resistance. Now, this level stayed as resistance until we saw this bullish breakout materialize on 12th of May. Right? Remember, 12th of May follows the weekend where some positive trade news emerged between the US and China. Right? There was trade negotiations that took place before that Monday in Geneva, Switzerland. And there was some promising news between the US and China, which led to even further optimism for global equity markets. And we saw the SPY ETF gap significantly higher. Remember, after closing on Friday, 9th of May at around $564, the SPY ETF gapped higher at 581. And since then, it has continued to climb higher. This gap has not been filled, so take note of that, right? Although this is a very, very huge gap, but it's not yet been filled. Similarly, there's another huge gap as well here taking place between Friday 23rd of May and Tuesday 27th of May. Remember, Monday 26th of May was a bank holiday in the US, so financial markets were closed, stock exchanges were closed. Right, so we can still spot two significant gaps that have taken place or that have occurred and have not yet been filled. So just to keep an eye out for these gaps as well. Right, we could probably see one of these, or well, this first gap here formed at the end of May, probably being filled uh, in the next couple of weeks, especially if we see equity markets start to pull back a little bit more than what we're currently seeing now. So, okay, so once again, the first support for the SPY ETF on the daily time frame is this overlap level at $575.77, and we can label this as the first support here. Now, the second support, I would probably see it as another gap here as well. Right, there's another gap being formed here on the end of April, but I do see a pretty decent overlap here as well. Right, what I would say is, uh, back in 13th of March and 31st of March, there was like a nice double bottom being formed here before markets kept lower. Then we see a little bit of resistance being formed at the end of April. So this once again helps us identify a pretty decent overlap level at $551, which we can label as the second support. But actually, when I look at the resistances once more, actually I'm more inclined to identify this current barrier here as more of an intermediate resistance, right? This is more of an intermediate resistance barrier at $604, and I think the first major resistance still sits at the intraday all-time high on 19th of Feb. So just let me relabel the resistances levels here, because you can see that the immediate resistance barrier at $604 is more like an intermediate resistance, whereas where we clearly see a strong swing high taking place is on Feb. Now that we've identified the first and second supports, we can also try and now we are now able to run a Fibonacci retracement beginning from this swing low here on 7th of April, going up to the intraday and going up to the high on Wednesday, 11th of June. When I look at all the fibs, we can see that the 23.6% retracement aligns very well with the first support. And we can see here, because of this gap here, I'm going to be using the 38.2% Fibonacci retracement as well. So we'll be using 23 and 38% in our analysis. Now, with equity markets pulling back, currently, right, I would also say there was a pretty decent ascending trend line previously, but this ascending trend line has now been broken, right? It got broken last Thursday. You can see here, SPY bouncing off this ascending trend line on 21st of April. And then here a couple of days as well, Friday 30th and 30th of May and Monday 2nd of June, and then bouncing off again in the first week of June. However, we've seen now the price break through this ascending trend line, and we could see probably a slightly deeper pullback materialize as well. Now, another level, intermediate support level that I want to be what I would like to highlight for you guys is this level here. I would say this is more of a pullback level at around $594.85, right? So if we see the SPY ETF break underneath this intermediate support at some point this week, right, I think we can expect a much deeper correction for this ETF. So let's just say if it does pull back all the way down to the first support, this would be a correction that's as deep as 4.9%, right? Not a very large correction, right? But a minor pullback, right? Between the high on Wednesday coming down to the first support, about 4.8% drop. Now, so take note, right? Although we've made a very strong recovery, equity markets still remain fragile, and the slightest negative news with regards to trade negotiations can have a huge impact on overall sentiment, market sentiment, and that could cause global indices to pull back much more deeper than what we're currently seeing now. So if this intermediate support at $594 doesn't hold up prices, right, we could expect this ETF to drop lower. However, remember, ETFs we are now in pre-market trading session for the US, and we can see the pre-market activity pushing the SPY ETF up towards $599.66. So yesterday, which was Tuesday, 17th of June, the SPY ETF closed at $597.53. And today's pre-market activity is showing us an increase in the price, right? So we can see futures price action actually rising higher, right? So we could see we are probably going to expect to see the SPY ETF manage to stay above $594 at least for today. Right. Now, let's see if there's anything else that I would like to highlight for the SPY. Okay, let's just say we see equity markets continuing to climb higher, right? And it breaks above the first resistance. Where could we possibly identify another resistance barrier? Remember, there's nothing else for us to reference. There's no swing high or overlap that we can reference. So in this case, we'll be relying on Fibonacci tool, such as a Fibonacci extension. So to find that extension level, I'm going to be running a retracement from this high on 26th of March, going down to the swing low on the 7th of April. Key extension levels sit at 127 and 161%. Now we can see the SPY ETF has already hit the extension at 127%. It's sort of stalled exactly pretty close to this level here. But and of course now that the SPY ETF has closed above the extension at 127%, right? This extension is no longer valid. However, the extension at 161% is still in play, and we can use this extension to help us identify the second resistance. So the second resistance right now is the level of the second resistance is has been identified by the Fibonacci extension at 161%. Right, so this is a good example of how we can use Fibonacci tools to help us identify the next potential resistance barrier when there's nothing else to reference. Right, typically we will be trying to be using previous market structures such as a swing high resistance, such as the pullback level or an overlap level to help us identify potential resistances. But when those market structures are not available, right, we're going to be trying to rely on tools such as the Fibonacci extension. The good exercise here on how we've used the Fibonacci extension to help us identify a potential resistance barrier beyond the intraday all-time high. Now, another thing I want to highlight is the RSI and stochastic oscillator, right? On the daily time frame, actually what I've spotted is, as of last week, was a bearish RSI, bearish divergence. And what do I mean by that? If we look at between these two vertical markers on 19th of May and the 11th of June, where we actually see price action for the SPY climbing higher, right? Price action for the SPY is actually climbing higher, but the RSI, which is the blue line here, has gone from 69.50 down to 65.30. So while price action has made a new high between these two dates, RSI has actually made a new low. So this is what we identified as a RSI bearish divergence. And typically when the RSI bearish divergence is identified on the daily time frame or the weekly time frame for the SPY ETF, typically we can expect prices to pull back. Now how deep that pullback is going to take place, it's open to debate. But nevertheless, once we do spot RSI bearish divergence such as this, is important to take note of, and we could see the SPY ETF pull back maybe a little bit more deeper than what we are currently seeing. However, for now, as of today, pre-market activity seems to suggest prices are going to be climbing higher. Now, where was the last time we saw a RSI bearish divergence? There was one that has actually taken place quite recently, and that was on between 5th of December 2024 and 19th of Feb 2025. Now, between these two dates, we see the SPY ETF making a new high, right? SPY ETF was about $608 back in December, and it reached about $612 by mid-February. So we can see price action making a new high. However, within the same two dates, we see RSI making a new low. RSI was as high as 68.79 on 5th of December, and then by 19th of Feb, RSI only made a high of 61. So we can see while price action made a new high, RSI made a lower high. This is called RSI. This is identified as a RSI bearish divergence. And what we saw after that was equity markets not only pulled back quite sharply, it fell deep into correction and it fell briefly into bear market territory. Now, just because we've identified another RSI bearish divergence uh, last week, it doesn't necessarily mean the exact same thing is going to play out. Right? There were different circumstances that led to a very strong correction that led to a brief bear market. Right? In this case here, right, we are seeing uh, the U.S. The U.S. government, the White House, being very tactful or trying to be very tactful with regards to trade negotiations, right? And they are aware that any overly aggressive moves with regards to levies is going to have a huge impact on equity markets, and they would not like to see that take place once again. So, although we have spotted an RSI bearish divergence once more on the daily time frame, right? Maybe this time round the pullback that we experience, that we're likely to see, is not going to be as deep or as strong as what we've seen here. Volatility could increase a little bit more, but perhaps it may not be as sharp as what we've seen between 20th of Feb and of course down till April. Nevertheless, the RSI bearish divergence has been spotted on the SPY ETF here. Now let's just that's what I wanted to highlight on the daily time frame. So these are the key support and resistance levels here, and also to highlight the RSI bearish divergence. So take note, we could see much deeper pullback for the SPY ETF, especially if this intermediate support level at $594.85 does not hold. All right, now with that, let's move on to the leading sector ETF, and that's the industrial sector, XLI. So let's take a look at how this ETF has been trading. So we go into search XLI, industrial sector ETF, right? And we can see, right, this ETF also made its latest intraday all-time high on Friday, 6th of June at 145.56. We can see that it has already climbed above the prior swing high resistance, right? This was a very significant swing high resistance that was formed in the first week of December last year, and it is pretty much where this ETF ran into resistance once more on 19th of May. However, we did see a clean breakout take place in the second week of June. However, prices have now fallen below this level once again. Right, so we can see how we can use prior swing high resistance. Oh, pardon me, prior swing high resistances to help us identify a potential resistance barrier as the XLI was rising strongly, and swing high resistances or resistance levels such as these can also be used in the identification of potential take profit targets. So as the XLI ETF was rising sharply, it made a nice V-shaped recovery, and also it broke out of this descending trend line as well. There's a very significant descending trend line that began on 23rd of January all the way till 3rd of April. And once this descending trend line got taken out, we saw a much stronger move to the upside. So this was almost like a bullish breakout. And once this bullish breakout was spotted, right, we can use several prior swing high resistances as potential take profit targets for the long trade. So for example, this swing high resistance at point A, this is at around $140, $141. This would have been used as a potential price target or take profit target as the XLI ETF made a bullish breakout here in the second week of May. And of course, as prices continue to climb higher, we would have used this second swing high resistance at point B as another potential take profit target as prices continue to rise, continue to climb. So take note, prior resistances can be used as potential take profit targets for the long trades, and especially once we see price break out of a very significant structure such as a descending trend line like this, quite likely the bullish momentum is going to be strong, and we can expect to see the upward momentum gain further traction. All right, now let's identify the key support and resistance levels for this sector ETF. Right, very clearly, first major resistance is where the new intraday all-time high was formed. Very clearly, this is the first resistance here. And generally, when price breaks out of a prior swing high resistance at $144, we can see, right, this is a very significant multi-swing high resistance with the first resistance or with the first swing high taking place on 27th of November, second swing high taking place on 19th of May. once the bullish breakout takes place, typically this area can function as support as well, but it's fallen quite easily back under this level. Right, so first major resistance is the intraday or close to the intraday all-time high formed on 9th of June. And I would also like to highlight an intermediate resistance barrier at the former multi-swing high resistance, right? This is a former multi-swing high resistance at $144. So I would like to label this as an intermediate resistance with the first major resistance at 145. Now, in terms of support, right, once again, we see a huge gap here in middle of May, right? And when I look across this level, it does look like to be a pretty decent pullback support level. We can see some resistance being formed here and at the end of Jan. Then we see support taking place on 12th of May and again on 27th of May. So this creates a pretty decent overlap at $139.51, which we can label as the first support. Now, for the second support, right, I can spot another good overlap, and this is at around $134.58. This was previously a significant swing high resistance formed on 26th of March. Then we see resistance once more in the first week of May, and then we see some support taking place in the second week as well. So pretty decent overlap level at $134.58, which we can label as the second support. Now on this uptrend here, of course, now we can run a Fibonacci retracement, beginning from this swing low on 7th of April, going up to the intraday all-time high on 6th of June, looking at all the fibs. Right, we can see 33.6% sitting at about $137.80. This is a little too far from where the first support sits. However, because of this gap here, right, and you can see there's a gap here on 5th of May, right? And the 38.2% retracement also sits pretty close to the second support, at least it sits a lot more closer. I'm inclined to use the 38.2% in our analysis here and highlight the second support more as a zone. Now, we can, as many of you may have noticed, right? The intraday all-time high has been formed here, 9th of June, first resistance. So how would we possibly try to identify the second resistance here? Once again, right, we can use a Fibonacci extension, right? Let's try to find that extension. We're going to be running a retracement from this swing high on 26th of March, going down to this swing low on 7th of April. Remember, key extension levels sit at 127, 161%. Once again, we can see the XLI has already climbed above the extension at 137%. This extension level is now invalidated, but we can use the extension at 161% to help us identify the second resistance now. The second resistance is at 149.36. Right, so for XLI, right, I don't see any pre-market activity for XLI just yet. Right, so but perhaps since the SPY is, let's quickly go back to SPY, since the SPY is showing or futures activity is showing us prices moving higher for the SPY, it's quite likely XLI is also going to be climbing higher in pre-market activity or in the futures, right, as it's been one of the leading sectors for the S&P index. Now, however, right, take note, first major support sits at $139.51. This is going to be a pretty important level. And when I look at the RSI level as well, right, we can also spot an RSI bearish divergence being formed between 19th of May and 6th of June, right? We can see here XLI has made a higher high between these two dates in terms of price action, but the RSI has made a lower high. So once again, a very clear RSI bearish divergence spotted last week. And we've seen this sector ETF pull back since that, right? Although the pullback has not been very deep, but it is still a pullback that is currently taking place. And of course, it is an RSI bearish divergence that needed to be identified as well. Right? It was important to take note of this divergence because this is where, right, once you spot an RSI bearish divergence, maybe you may not want to short the ETF itself, right? But at least at this point here, once the divergence is spotted, you would also not be adding to any long positions at this point here. The worst thing you can do is after spotting an RSI bearish divergence is to add even more long positions at the highs. Rather, wait for a nice pullback to materialize, which is something that could happen over the next 1 to 2 weeks, right? And then try and identify a potential pullback and a much better entry price to go long. So once again, right, once we have spotted the RSI bearish divergence, we do not necessarily need to short the instrument or short the ETF here, right? We can actually wait for a nice pullback to materialize before getting a better opportunity to go long on this ETF. Once again, let's see if there's a RSI bearish divergence spotted before. Yes, there was one spotted here between 11th of November of last year and 27th of November. So within a space of 2 weeks, we saw price action. We saw price action for the XLI make a new high, but over the same period, we saw the RSI make a new low, right? RSI, right? If you take a look at this panel here, the RSI went from 71.21 down to as low as 64.40. So RSI made a new low, price action made a new high, RSI bearish divergence spotted. Worst place to go long at this point here. If you're not looking to short, at least wait for a nice pullback to materialize. And then once the pullback materialize, you could see it gives you a much better opportunity to go long. But of course, after that, Liberation Day took over and we saw a very strong pullback correction take place for this ETF as well. All right, so coming back here, right, you can see RSI bearish divergence, one spotted. On the daily time frame for these ETFs or on the weekly time frame is very important, and it really helps us to identify what is the next move, what could likely be the next move for that ETF. All right, okay, so this is the key levels here. The next leading sector that we had was communication services, XLC, right? So let's take a look at that. Right. Similarly, we could see a very similar market structure as to the SPY ETF, right? We see a nice strong V-shaped recovery, and we can see that although it did not eclipse the prior intraday all-time high, it came pretty close to it in the middle of June or last week. So very clearly, the first major resistance for the XLC ETFs is at $105.31. Right, and for those of you who may be guessing already or would already know by now, to find the second resistance, we'll be using a Fibonacci extension. And to find an extension, we can run it from this swing high on 26th of March, going down to the swing low on 7th of April. And once again, we can see as this XLC ETF was rising sharply, it stalled. Not only did it stall close to the prior swing high resistance, it also stalled close to or within where the Fibonacci extension at 137% was sitting. So you can see here the combination of the prior swing high resistance on 18 Feb and the extension at 127% help us identify a pretty strong resistance barrier. And this was a zone that I would have used as a potential take profit target as this ETF was climbing higher. Take note, this was also a swing high resistance. So that means as price was coming out of this reversal, right, I would have used this swing high resistance at $100 as one of the potential take profit targets as well, right? And also, especially when price makes a bullish breakout, remember this is a very significant descending trend line. This is a very significant descending trend line that got broken on the first week of May, and that led to a very sharp uh, uh, increase in price, right? We saw XLC ETF accelerate, right? Breaking through this after breaking through this descending trend line, and then we would have used this prior swing high resistance as one of the potential take profit targets. And of course, as this ETF continued to climb even higher, we would have used the combination of this extension at 137% and the swing high resistance as the next take profit target. So you can see here as the bullish breakout materializes, right? We really see the upward trajectory gain further traction, and then we use prior resistances and perhaps Fibonacci levels as potential take profit targets. Now let's try and identify, okay, we've already labeled first resistance. Now let's label the second resistance, and then we can move on over to labeling the first support. So second resistance here at around $110. Now let's try to find support. Remember, a prior resistance, once it gets broken, can function as strong support. And when I look across this level now at $99.94, I actually can spot a very nice overlap. Right, we can see swing high resistance formed here on 25th of March. And then we see almost like a nice double bottom formed, being formed on 23rd of May and 3rd of June. So this creates a very significant overlap at $99.94, which we can label as the first support. Second support, let me see. There's a gap here. We can actually spot, I can spot a very nice overlap as well, right? We see a small swing low taking place here in mid-November of last year, a very significant swing low bounce taking place in mid-Jan of this year, another significant swing low bounce taking place here on 13th of March, another bounce here on 1st April, and then some resistance here on 20th of April. So this creates a pretty significant overlap level and $95.11, which we can label as the second support. Now we can also include the Fibonacci retracement. Right, we're going to begin the Fibonacci retracement from this swing low here on 7th of April going up to the high of last Wednesday. Looking at all the fibs, we can see that 23.6% retracement aligned very well with the first support, and 50% sits pretty close to the second as well. So we're going to keep 23 and 50 in the analysis here. Okay, 23 is not so visible, right? But let me just show you guys where it exactly sits. Right, 23% is here, 50% is very close to the second support as well. Right, let's see if there was an RSI bearish divergence being spotted here for this ETF. Right, this is the XLC ETF, communications ETF. Actually, not quite, because you can see RSI here on 16th of May was about 69.91, and then on 10th of June RSI was about 71. So RSI actually made a new high. Price action also made a new high, so no RSI bearish divergence spotted for this ETF XLC this year. But perhaps there was one. Yep, there was one spotted in from between 6th of December last year and 14th of Feb this year. Right, once again, we see price action make a new high for the XLC ETF, going from about $101.50 to as high as $105.80. And over the same period, we see RSI going from about 77.81 to as low as 72.75. So once again, very nice RSI bearish divergence spotted, right? And once again, once you spot the divergence on the daily time frame and perhaps even on the weekly time frame, right, this is the worst place to go long, wait for the pullback, or perhaps if you are also looking to short the market, it's also a good idea as well, especially when we see price break out of a key ascending trend line as well. So we can see here, right, key ascending trend line between 14th of Jan and 19th of Feb, right, almost 4 weeks, key ascending trend line getting taken out, RSI bearish divergence also being spotted, and we can see this ETF dropping as much as 9.6% from the breakout point at the end of Feb till mid-March, right, within 2.5 weeks. This ETF already dropped more than 9.6%. Right, so once again, right, we've spotted on there's no RSI bearish divergence spotted, but in fact, I would say we have a very nice upward channel here, right? This upward channel is currently being tested, right? The lower trend line of this upward channel is currently being tested, right? And if XLC can regain momentum and climb back into the channel, right, then we're likely to see the bullish momentum help push prices higher. However, a clean break out of this downward channel could signal a much deeper pullback, perhaps all the way down towards the first support, which is an overlap level at $99.90. All right, before we continue, or rather, this brings us to the end, towards the end of today's session. But before I leave you guys, I'm just going to launch a poll as well. Truly appreciate it if you guys can give your feedback with regards to today's webinar. And of course, should you have any questions, please do drop them in the Q&A box. More than happy to answer your queries as we wrap up today's session. Right, I'll keep the poll running for another 20 seconds or so. Right, great to see all the responses coming in, right? Right, I think that's most of you have voted. All right, truly appreciate it. Thanks so much. Right, so just to wrap things up, right, we've seen a very strong recovery in global equity markets. We see the SPY ETF make a strong V-shaped recovery, XLC make a strong V-shaped recovery, XLI as well. Let's go back to XLI. Right, we spotted the RSI bearish divergence on the XLI. We've also seen, yeah, we can also see on the XLI, oops, uh, the bullish channel, price breaking out of the bullish channel here. There's a very nice bullish channel that had developed from 9th of April all the way till 6th of June, but it's broken out of this bullish channel, right? Especially after the RSI bearish divergence has been spotted. So perhaps we could see a slightly deeper pullback, but based on pre-market activity for the SPY, right? If you see the SPY climbing higher in pre-market activity, remember the SPY closed on Tuesday, 17th of June at $597.53. We're actually seeing it $2 higher in pre-market activity. So if SPY is rising and XLI, XLC are the leading sectors for the ETF, for the overall S&P 500 index, we're likely to see those ETFs also climbing higher alongside the SPY ETF as well, right? Okay, so that brings us to the end of today's session, right? Thanks everyone for tuning in to this webinar brought to you by IronFX. Do look out for all our upcoming webinars. We've got another one tomorrow as well. I believe it's a live analysis taking place at the same time tomorrow. All right. Thanks everyone. Take care. Have a great trading week and catch you all in the next session.